Welcome to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank that brings you market views and insights on the go.
Hello everyone, my name is Zhong and welcome to the first installment of our 2024 second half Outlook podcast mini-series. In our 2024 Outlook released end of last year, we posted that equities and bond markets are likely to start 2024 on a positive note. We nailed the former, but the latter didn't occur as we expected. We also added that we were on watch for a shift in the macro winds. We believe the macro winds are shifting now as we approach a potential inflection point in the form of central bank rate cuts and the US elections. Hence, our second half Outlook report, titled Adapting to Shifting Winds, could offer an investment playbook for investors to navigate the shifting winds in the second half of this year. To discuss the key conclusions of this report, I have with me Manpreet Gill, our Chief Investment Officer for Africa, Middle East and Europe. Hi Manpreet. Let's start with the shifting winds. What do you mean by that?
Hi, Zhong. Thanks for having me on. I think it helps to go back to the start of the year. So we started 2024 with a sailing with the wind theme. And as a part of this, we discussed potentially adjusting strategy as fundamental drivers shifted through the year. Now, fast forward 6 months to today, and the one big shift we're experiencing is that major central banks have started to cut policy rates. So Europe, of course, the front runner along this path. We've had the central banks in Sweden, Switzerland, and indeed the European Central Bank already cut rates as growth and inflation slow. And we believe the US Fed has room to follow suit later in the second half of this year. So that's one sort of shifting wind we've seen. The other, of course, is later in 2024, we have the US presidential election. Now, history might show us that since 1972, the S&P 500 has, on average, delivered positive returns in the 6 months before and after elections. But there is an elevated risk of a bit of volatility in the weeks around the election itself, including in years when the Fed was cutting rates. So there are two sort of big shifting winds that we think strategies will need to adjust to.
Okay, so the macro winds do seem to be shifting. How do investors then adapt to the shifting winds?
Well, for us, we think there are three ways investors can adapt. Number one is that we think a portfolio should stay overweight equities over bonds and cash. Second is that we believe a portfolio should favor US equities in a global context and Indian equities within Asia, Japan. And third is we think portfolio should own gold and emerging market US dollar bonds as diversified sources of return. Now, in the environment we just described, one would expect balanced foundation allocations, which comprise equities, bonds, and alternative assets, to outperform allocations that are solely aimed at generating income. Just by nature, of course, expecting equities to outperform bonds. So that's on the foundation side. Opportunistic allocations, of course, we think portfolio should continue to favor growth sectors in the US, a more barbell-like strategy in Europe, and more focused potential beneficiaries of public policy in China.
Let's pick up on the strategy to overweight equities over bonds. What are the reasons and how to invest with the different regions?
So the big factor there, of course, is that for the US, we expect our view of a soft landing for the economy to pan out. We discussed the Fed potentially cutting rates preemptively, and we think that will avoid a sharp recessionary slowing of economic growth. And for equity markets, we think that, of course, should help extend the earnings cycle and support outperformance relative to cash and bonds. Now, regionally, we believe US equities offer the strongest case for continued outperformance relative to other major regions in the second half of the year. Now, our positive view on US earnings, of course, remains a cornerstone of that view. One pushback we receive, of course, is that US valuations, they're undoubtedly high. But as you'll see if you take a look at a report that we do believe that's justified because of the higher return on equity on the market. The only point I'd add there is that equity market gains in the second half could come with a bit more volatility than the straight line up we experienced in the first half of the year. That's the US, of course. Beyond the US, we do have more of a new core holding view on many other major markets. So we've upgraded Euro area equities to core holding. Some challenges, of course, from the political front, but we have seen some surprise improvement in some of the higher frequency growth data. We've also reduced Japan equities to a core holding. The positive case we think still intact in terms of the shareholder friendly policies, but we are seeing an extended negative signal from our short term technical model. The only region, of course, we're underweight is the UK. Uh, on just digging into Asia ex Japan, of course, for a moment, we're overweight Indian equities within that. Similar case to the US, of course, where the economic and earnings growth outlook is positive. Valuation's a little bit of a challenge, but we think justified by a high return on equity. Finally, on Chinese equities, we maintain a core holding. Positioning and valuation suggest that a lot of the easy gains may now be behind us as we moved away from those excessively negative extremes on valuations and positioning. So this, of course, now puts the onus on earnings growth, which we think will require more policy support.
I hear the argument for equities, but are there no opportunities in bonds?
There are, and thanks for pointing that out. We shouldn't ignore bonds as an asset class, of course. And here we think carry, or in other words, earning the yield, remains the key opportunity or theme in bond and FX markets. Uh, of course, it is a lot harder to find value. So that's why we're overweight equities, but we do have more of a core holding view on global bonds. Now, history reminds us that US dollar bond yields generally peak not far from when the Fed stops hiking rates and they start falling near or ahead of when the Fed starts to cut rates. So, once again, we reiterate our long-standing point that it argues for locking in today's yield, especially relative to holding cash, where we still believe reinvestment risk is considerably higher, especially as we approach more and more central bank rate cuts. We do have a neutral view between government and corporate bonds. You get a slightly higher yield on the corporate side, but the yield premiums relative to government bonds offer relatively little value where we are today. It's in emerging market bonds where we see pockets of both opportunity and risk. So we're overweight emerging market US dollar government bonds because we believe the relatively high yield on offer and the slightly better value means we think there's a stronger case there to outperform global bonds, not so much on the local currency side where we remain underweight.
Finally, very quickly, any changes to your opportunistic ideas?
Well, there are a few changes here. We have, on the equity side, we've added a new buy idea on Japanese banks. We discussed, of course, the short-term technical signal being a challenge for the broader market, but we believe this idea should offer more focused exposure to what we see as an undervalued sector, with exposure to the long-term recovery in Japan's economy and rising net interest margins at banks. To balance that, we're closing our buy idea on South Korean equities, even as we keep our, of course, buy idea on Taiwan open, and that's just about trimming exposure to the semiconductor subsector. On the bond side, we have added a new buy idea on US agency mortgage-backed securities. We believe the risk reward here is attractive given the robust yield, the quasi-sovereign credit quality, and what we see as contained mortgage prepayment risk, given a lot of the refinancing was done during the COVID period. So a few new ideas there.
Thank you so much for your insights, Manpreet. That's really a very brief overview of our outlook for the second half of 2024. To find out more, please look out for our H2 Outlook report, which you can download from the link in the podcast description. We'll be releasing the rest of the second half Outlook podcast mini-series gradually over the next week. Thanks for listening from start to end. We wish you a fantastic second half of the year.
Thank you for listening to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank. For more details, visit Market Views on the Go on our website or click the link in the description.